Welcome to the Daily Update. This is Being Prepared Friday, September 23rd, where we'll look at the action in the market today and then see how things look for Monday, September 26th. And there's going to be some repetition in this video because what we've been seeing is just playing out more so, but we're actually kind of getting close. If there's a point of critical mass where the market's going to find some kind of a bottom, we're seeing a convergence of things coming together on multiple time frames. If it's going to hold up, if we're going to get some bounce out of this, it's probably getting close, if not at that situation right now. Now, how much of a bounce are we going to get if we even get one? That has yet to be seen. We're still seeing some of the late day recovery, and that's what the smart money likes to do. We're seeing that pattern going over. We're starting to see sentiment getting really fearful, and we're seeing support. We're right at support right now with the S&P 500. We see a lot of those things coming together and an oversold situation, and we could get some kind of a bounce from that. How strong that's going to be, we don't know at this point. So let's go back and talk about what happened. Right at the open, we had a gap lower. Man, it was not very good. We gapped below S1 at 37.41. We also went below S2 at 37.25. Eventually, prices fell down below S3, and that doesn't come up on the chart all that often. And that was at 36.83. As the day went on, prices continued lower, but they didn't get all the way down to S4. I actually calculated that and have it on the chart. We didn't get that far, but we got close. But we did get right down to that June low. We actually went right near that level. We closed above that level, but we went down and kind of tested that level. Is this the test we've been waiting for? That's what we need to look at now, because we came up from that low. Are we going to see some support underneath the market now? Going into the close, we did see some late day buying yet again. That's a pattern we've seen for about a week now. Early weakness, that's the amateur hour. And then the last 1 to 2 hours, we start seeing the market recover, even on down days. And that's typically what the smart money likes to do. And it took prices back above S3. By the time we closed, we were still down 1.72%. Volume was above average. And the technicals, yeah, they're negative, but we're pretty oversold right now. And I'll show you the charts to back that up. Inflation and interest rates, not only internally in the US, but we're hearing more and more now about foreign inflation and raising interest rates in other countries. This is more of a global situation that's happening right now. Of course, the geopolitical concerns, there's still a lot of rumblings from Russia, Ukraine. That could escalate and get ugly pretty quickly. That would then take it to the forefront and have some impact on the market, obviously. Earnings are still kind of coming out. The recession debate, that's kind of on hold right now. As I've been saying, it's like, look at your own situation. Are you in a recession? Are you not in a recession right now? And that's pretty much as far as you need to take it, because you go to the higher level and you get this debate going back and forth while the market's doing its thing. And then we might get some kind of Fed speak. There was a lot that came out last week. Will we get any in the upcoming week? So some comments. Higher interest rates, they're still going up, and that's providing a lot of headwinds for stocks right now. The Dow closed below the June low, so it actually went down below that. But the S&P, after coming down to that level, it was able to close above the June low. I look at the S&P as a more broad-based barometer of the market, and so I focus on that, not only for all the strategies that I do, but for trying to figure out what's going on in the market. I would have a tendency to look to the S&P right now to see if that June low can hold. And then the UK Prime Minister came out. This is more the international things. And they said they're having a lot of tax cuts. And these are the biggest tax cuts they've ever had there since 1972. And they're trying to produce economic growth. And what happened is their bonds there called the gilt, the 10-year gilt, it was up to 3.85%. Then as market participants recognize that it will be financed through the issuance of more debt. So how they're going to fund this stimulus is by taking on even more debt at the time of rising interest rates. That didn't sit so well in the UK, and it kind of bled over into the EU. Also, there were concerns that any efforts to spur on growth will keep inflation going because we're just adding more money to the system. There's more debt out there, and that could end up kind of backfiring. Also, this sent the British pound really down, and it's been really going down against the US dollar. The first time I went to England, it was about 120 to 1. I went a little while after that, it was 1.5 to 1 in favor of the British pound. We're getting down to 1.08 right now for the British pound. And the dollar, just because it's the least crappy currency out there, people don't know what to do. So they're going into the dollar, and it actually went above 112. And then Goldman Sachs came out and cut their year-end price target. They had been at 4,300, and those are some of the IsabelNet charts that I've been showing you. Well, now they're lowering it to 3,600, and it sees that we could go as low as 3,150 if we have what's called a hard landing. That's where interest rates go so high that you basically tank the economy. The Fed is always trying to ease interest rates at just the right point so that economic growth can continue. That would be a soft landing. Well, we'll have to see how that plays out. All 11 sectors ended up being down on the day. The transports are going lower still, hitting another 52-week low. The Dow's starting to drop a little bit too. So we're not seeing the real divergence that we were seeing. We're oversold in the short and intermediate term. And I even have some long-term charts that could be suggesting that. We still have the 30 to the 5, the 10 to the 2, and the 10 to the 5. Those yield curves remain inverted. Sentiment is getting fearful and starting to get extreme fearful. We still have a ways to go, but it's looking a lot more fearful right now. We had really a light day as far as economic reports. We had these preliminary September IHS manufacturing PMI that came in at 51.8, a little more than what we saw last time at 51.5. And then the marketing PMI came out at the same. It was at 43.7. Not real big market movers. Our trend is negative and we're above 20. Of course, we have the bias as negative with another down day. The momentum continues to be negative. We're going to have to see follow through price action. If we're going to get some kind of a bounce, we can't just guess, well, I think a bounce is going to happen here. Let other people take care of that. We need to see some price confirmation in the charts to see if some kind of a bounce is, first of all, even going to materialize. And we'll have to see how things open on Monday. Are we going to gap lower? Are we going to gap higher? Are we going to be unchanged? We have the whole weekend to go over where things can happen to drive that one way or the other. But then after the open, and then especially going into the close on Monday, that's what I'll be watching really closely. All right, let's go back and talk about what happened more on Friday. See how we're tipping down below 25 with the extreme fear. That's been going down. It could go down further, but we're starting to get to that point where people are ready to just dump everything. And that's when we want to be looking at the contrarian view at that point. Here's the historical chart. The Ridex bear bull ratio spiking up a bit, but then this is lagging by a couple of days, but it is going higher. So folks are tending to get into the bearish mutual funds instead of the bullish mutual funds. This, I just keep here just to kind of confirm this. I actually showed this in yesterday's video, but the reading for American Association of Individual Investors, they're still extremely pessimistic. And quite often we can use that as a contrarian indicator. We're still getting very low readings from the active asset managers. That can be used as a contrary indicator. We dropped below 30, but this is a little bit old now. And then the LEI, the leading economic index or indicator, the line I look at the most is the blue line. And this just suggests that we're going to see economic weakness going forward. Here's another one just showing those that use leveraged instruments like leveraged or juiced ETFs or futures contracts for the S&P. They are really going down. right now to try. They just want to try to not lose money, let alone make money. And then it's comparing it to the emerging markets, the Nikkei in Japan and the European Union. They're holding up a little bit better, where they're really getting out of the leveraged positions in the S&P 500. And they still remain negative in Europe. And then this is just another chart that kind of goes along with one of the charts that I show in the weekly video. This is the current market valuation, the stock values to GDP. It's called a Buffett indicator. And if you kind of look this over, it's still suggesting that we're pretty overpriced right now, according to this particular chart. And again, I'll show this again in a different form with the weekly video. This just shows what the interest rate situation has been. The blue boxes show where this is what the Fed's actually already done. And then the shaded areas are what they're forecasted to do into the future. And we still see this going up overall. And then getting back here, they possibly in February 2023, maybe topping out at that point. So we still have some time to go there. This is the initial jobless claim, showing how it did come up a little bit, but we're still a lot lower than what we've been in other years. And this is helping to give some support to the employment situation. Here's the look at the value versus growth. Everything was down across the board. Actually, value was down more than growth overall in the different areas. The VIX is starting to get a little bit higher, but still not really spiking up at this point, both with the line chart and the bar chart. And the VIX of the VIX really spiked up with that move up in the VIX itself. This is an interesting one. We're seeing the RSI 9 period based on the VIX starting to get pretty extreme. Now, this is relative, where the other numbers, the other charts back here, these are more static numbers when we get above and below. That's why I put the moving averages on here, because these numbers can change. Where this is just measuring based on recent activity, the RSI has gone up pretty far, pretty fast, and we're just slightly into overbought territory, which the VIX is high, it's time to buy. That could signal that we might be either getting close to or at a bottom right now. The Ulcer Index, which measures fear, continues to go up. The mass index not giving us a signal right now. This just shows the retracement. And if you see this bar, yeah, we had a gap lower, but we went down. We tested the lows back in June, and then we came up well off that bar. This red line is where we closed. That's kind of, you could take that as positive for right now. We'll have to see. A lot of folks will only see this in hindsight. If we end up going up here, then they'll go, yeah, remember that Friday when we tested the lows and then we've been going up ever since then? We can't do that. We need to look at things as they're happening and try to figure out, are we going to see some continued follow through going from here? We saw just a massive spike up in the equity put call ratio. As we were getting down to the June lows, people were just jumping into puts like crazy, but it hasn't really affected our 5-day chart that much yet. Here are the pivot levels for Monday's session right here. And then here's where we showed we came down to the support level. This is the June low, and then bounced up off of that. Now we're below S2. That's negative. Can we first get back above S2 at about 37.07 or 08, right in there? And then volume was above average. Here are the pivot points for the month of September and just how we've been behaving ever since then. Here's a short-term fib level, again, just suggesting that we're coming down and testing the June lows. We've retraced everything that we got back has pretty much been given up to this point. Here's an intermediate term chart showing the same thing as well. So we want to see if these June lows are really going to hold now. Here's a longer term chart showing how we've been breaking down. If we do go through the low in June, now we're going to get down into the 35.14 area, at least on this fib chart. There's a lot more room to fall if we end up taking that out. Weekly chart also, we're below the 38.2% retracement. We do have the long-term moving average that could act as support here, right at about 35.85. If we break through that, then we have the next fib level at 35.07. So a lot more damage could still be done. We did start to break below the midpoint of this trend channel. That could be negative. But there's other times when we broke below that only to come back up. So we'll have to see, is this going to be one of those times, or are we going to continue to fall? The sectors, all of them are down, with energy, believe it or not, leading the way to the downside, followed by discretionary, which had been kind of sneaking along, doing better. It's pretty much given all that up now. And then healthcare ended up being down the least in Friday's session. Here are the scooter scores showing that there's really only one chart, utilities, that are in the 90s right now. The staples and the healthcare and the energy, they've really been getting hit on a technical analysis basis. Here's the sectors showing how energy, it's still in the lead, but it's given up a lot of gains. Utilities also doing fairly well, but giving up some gains, where all of the other sectors continue to be negative. Here is just the updated chart of the different indexes. The pink, that's the S&P 500 and how they perform since the S&P 500 made its all-time high. Technical alerts, I had to really scrunch this down, and they're all negative except one. You had the dollar setting a 4-year high. All these other ones are negative since they're red. The S&P went below 20. I'll show you a chart of that. With the BPI, we crossed below 3,700 with the S&P. That's all I see for the S&P 500, but this is just negative. And when we see a convergence of all these negative signals happening at the same time, that could suggest some kind of critical mass, some kind of a bottom could be forming. Our scores, we actually have the Dow in first place now at 56.8, even though it's been down. See how this line's been going up slightly? It's been showing some improvement. The S&P has jumped into second place. It improved 4.3 points, and it's turning up a little bit. Even with the down day, it's showing some improvement. The mid caps, which had been leading the way, they continue to decline. Small caps are still really struggling, even though they were unchanged at 35.2. And the Qs, even though they improved a little bit, 5.2 points, they're still in last place at 22.7. Here's the chart where we just gapped lower. And a lot of that was coming out of Europe. We just left S1 and S2 in the dust, and we came down to this point. Eventually, we worked our way down to S3, which I had to add to the chart. We got close to S4, and then this is the improvement that we were seeing going into the close. And we've been seeing that other days too, even on down days, late day buying. So let's see if that will follow through and give some support. Our trend is decidedly negative. The ADX is going higher and the red line's just shooting up right now. We're still extreme. This is another potential exhaustion measurement because we're extreme negative with the Arun indicator. Breadth, we're just not looking very good here. We're going to have to see some real buying to come in. Even though we haven't made a lower low in this recent move based on price, we are making lower lows based on volume. So that would be a negative divergence. And we're just seeing this really dropping down currently. The advanced decline ratio also still getting even a little bit more extreme negative. New highs, new lows are negative. And look at this expansion. And if we do break support, this line is just going to really, it'll be like this line over here. But we're still negative overall. So there's not a lot positive to hang our hat on, other than we're seeing an awful lot of extreme negative things at the same time. Accumulation distribution, it's actually been holding up. It's right back down to the moving average. Short term, they're pretty much a negative across the board with the decision point, although they remain neutral with their short-term trend model. Rate of change, 5 periods, still extreme negative, as well as for 10 periods. Stoke RSI, extreme negative. Williams percent R, extreme negative. Force index coming down to the Keltner band, extreme negative. Swinland trading oscillator dropping below based on price and volume. That's becoming more extreme negative. McClellan oscillator, extreme negative. The moving average study, extreme negative with the 20 and 50, and starting to get more extreme with the 200. Stochastics, all of our studies are extreme negative right now. Intermediate term, starting to generate a new signal with the 19-day exponential moving average based on price and volume. We're still far away from the standard price or the average price or the mean price. And it just means that we've gone down pretty far, pretty fast. And the tendency would be for this to come back down. That will probably happen if the S&P ends up going up. Rate of change 20 periods is also extreme negative. The Sean trend meter, extreme negative. The PMO, negative and starting to get extreme. And our PMO study, the rising PMOs, extreme negative, declining with the buy signals, declining with those that are above zero. Chaikin oscillator still slightly above the midpoint, but is declining. And the Chaikin money flow is turning more negative. Volume is continuing to pick up slightly. The vortex is negative with the red line on top and the green line on bottom. Summation index based on price and volume continues to drop. And you might suggest that we're getting to an extreme reading based on volume. The slope finally is kind of rolling over and deciding it's going to go down too with all of the other oscillators that we're currently looking at. So this is pretty much negative across the board here. We're getting extreme negative with our BPI, bullish percent index. Ease of movement is turning down and below zero. Ultimate oscillator turning down slightly. Money flow index declining. CCI 14 extreme negative. CCI 20 extreme negative. The RSI 9 period extreme negative, and we're just starting to go extreme with the RSI 14. Boom indicator, extreme negative when you compare it to the 20-day moving average. Still have more room to decline with the 200-day moving average. Here's where we're setting a new closing low with the Dow. We set another new low with the transport. So now these are confirming each other, which could be more negative because they're going down, where the utilities are declining, but they have a long way to go before they get to their low that we set earlier. And again, a lot of people just use the Dow and the trannies together. I include utilities. The TTM squeeze is starting to look more negative again. Balance of power is right about in the middle currently. It's kind of interesting. It's not moving all that much. Our CMB composite index, it is negative, but we could be getting close to some kind of an extreme reading that we've seen before. Here's one I haven't shown in a while, the Connors RSI. It's starting to get extreme negative, and it doesn't give us a lot of readings. The last time we had this reading was back in June, right before we had the nice little run up. Well, could that be happening again? On our different charts, our Heikin Ashi is decidedly negative, as is the Kegi. The Renko is negative. The three-line break is negative. We added some more zeros with the point and figure, and it's generated this is a spread tree three bottom breakdown. Okay. It's really hard to read that, but this is negative, and it's also generating a negative signal. We are negative with the Elder's Impulse for the S&P and the SPY. We're negative with the SAR. We're negative with the go, no go. Long term, we're starting to get extreme with our 50, 150, and 200-day moving average studies. Rate of change, haven't shown this in a while, not since June. We're coming back down to this point. In fact, we've dropped a little bit below that. So even longer term, we're starting to see some extreme negative readings. Special K continues to decline. The diamonds continue to be negative, and see how we did actually go below the low set in June, and we closed below the close on that day as well. We dropped below S2, but we did come off of the lows. That's positive. The Qs continue to be negative, and we're just above S2 here. The Vixen, is spiking up a little bit as the NASDAQ 100 continues to fall. NASDAQ is right at S2. Who can figure this stuff out? The fact that we closed right there. Mid caps coming down to S2, but still slightly above it. Wilshire 5,000, still, it's hard to see because of the volume bars here. We still have S2 below where we're at right now. Looking at some other indications, the dollar's just going up, 112, almost at 113, my goodness. And then the S&P and the US dollar have been going in pretty strong opposite directions. Gold had another bad day, as did silver. Oil has actually dropped below 80 at 78.74. And oil and stocks, since they're both falling, they're going in the same general direction. Bonds continue to show weakness based on price, and we're just breaking below the COVID lows with the World Bond Index. As yields, here's the 10-year Treasury. It's continuing to go up. It's breaking out basically at 3.697%. Here's the 30-year. We're getting right up to the 61.8% retracement. This is long-term. This goes back 2008 to 2020. Is this going to offer resistance and help interest rates to come back down? Stocks and bonds are having a real tendency to go in the same direction. Our yield curves, 10 to the 5 is inverted, 10 to the 2 is inverted, 30 to the 5 is inverted, still not inverted with the 10 to the 3 month. Tech sector to the 10-year, opposite directions as yields continue to go up. But look at how we spiked up in the longer maturities, but we really came down with the 3 month. Our scenarios really just to update it here. We pretty much have lost the Copic curve right now. That signal is no longer valid. We're starting to get extreme with those stocks above their 200-day simple moving average. We are generating another signal now with those S&P 500 stocks above their 50 moving average, and with the mid caps extreme and the small caps. So we're seeing a convergence of extreme readings. The 10-day average of the highs and lows, it's getting negative, but it has not gone extreme, at least yet. The broad market for the highs and lows over 5 periods really showing some weakness and not necessarily extreme yet. We're seeing a real spike up in the equity put call ratio, but it hasn't really figured into the 5-day average yet. Once that starts to get involved, we might see this really spike up above 0.8, which would be another signal. Small caps right down to S2 and close just above that. And they really underperformed the S&P 500. So we're not getting any help from this chart. The S&P and the 10-year yield are going in opposite directions. All of our sector rotations are negative now. Yeah. The S&P to the 2-year, as the 2-year is going up and down, the S&P is going down. They still have a pretty strong inverse relationship, and it continues to spike right here. We just have to wait and see when that spike finally gets fixed. The S&P is really underperforming utilities, so that's why this ratio is going down. The staples had a hard day as well, but on a relative basis, this spike is coming up. So we want to watch this. It could take out this other spike that we've been working from. So what's our outlook? The technicals are negative and oversold. All right. We don't have any reports coming out on Monday. Geopolitical events, Russia, Ukraine, we have to keep an eye on that, but the markets are still fixated on inflation and interest rates. Our scenarios, we have to go with the down one until we see some positive price action, because everything is pretty ugly, but it is oversold right now. So going short may not be all that warranted either. We can't go with the up scenario because nothing has really turned positive yet. And we don't go sideways because the ADX is above 20. So our conclusion, negative. Short-term oversold, intermediate oversold, negative, a little bit of oversold, and we are negative overall. So thank you. Have a wonderful weekend. I will be posting the weekly video and the intermarket analysis video as I get a chance to record those.